This chapter kicks off with discussing using regulatory accounting for capital cost recovery. And first up on the list is customer contributions in aid of construction. As with any of the topics that we're discussing here today, if the amounts are not material to your financial statements, you should not really delve into the use of regulatory accounting for those items. But for those items that will have a material impact, and you know what materiality is for your financial statements, I would generally take 1% times your annual revenues, and that would be material to your audit report. Now, don't tell your auditors that you know that, but for future reference, that's a good rule of thumb. I'm just joking. Obviously, you can tell them that you know that, and it helps in your audit discussion in any case. But first up on our discussion today, again, is contributions in aid of construction. Now, this also applies for when you install services or service upgrades for customers, special hookups for industrial customers for transformers, interconnects to bring power supply to your community, things like that. It all applies under the broad umbrella of contributions in aid of construction. And for those of you that are not familiar with contributions in aid of construction, what are these? Well, as subdivisions are installed for future homes, the infrastructure is put in place for electric service or water service or wastewater service right up to the property line. So this can be the electric overhead and underground facilities, the water main up to the water service point, wastewater main up to the wastewater service point, street curb and gutter. And in many cases, the developer pays for these improvements, but it really doesn't want ownership of them. They're putting these into the subdivision so that they can sell the lots to new construction, to folks that want to build homes, to businesses, and so on. And so what the developer does is they contribute these infrastructure improvements to the local utility. And on transfer of this property from the developer, the utility then owns it. Then they maintain it. Eventually, the utility must replace these assets at the end of their useful life. This whole process of constructing the infrastructure, transferring it to the utility, so now the utility has ownership of this, these are called contributions in aid of construction. And they directly impact capital cost and recovery of capital costs from your ratepayers. So let's dig into that a little more deeply. Utilities that follow GASB accounting standards have to use GASB Statement 33, which is accounting and financial reporting for non-exchange transactions, to record contributions. And that standard basically says, all right, governmental entity, in this case, utility, you've received something for nothing. And so this requires that a utility recognize the contributed infrastructure as a revenue in the year the infrastructure is installed based on the installed cost. Now, as we know, a lot of governmental standards are built more for general fund accounting, municipal type accounting, state type accounting. When it comes to utilities, it's a little different. So in this standard saying, you need to recognize a revenue for a long-lived asset, but recognize that entire revenue in the year that this transaction took place, i.e. the developer gave you the contribution in aid of construction. It doesn't totally fit the utility business model. Now, for utilities that follow Financial Accounting Standards Board standards, private sector utilities, electric co-ops, they recognize these contributed assets as a reduction in the cost of the assets, which would equal the installed cost. In other words, the assets will have a net cost of zero for a FASB following utility. So think with me here, we got $3 million of assets. In GASB, you would record $3 million of revenue as an offset, but in FASB, you would reduce that $3 million of assets to zero. Makes a lot more sense, doesn't it? We didn't pay anything for it. Why should we record the receipt of this asset? Even though we own it, it's really net cost of that is zero. So for the GASB following utility, the asset has a net cost that equals the installed assets cost, and the GASB utility now must depreciate this asset for, they didn't pay to install these assets, and so there's an inequity between rate recovery between GASB and FASB utilities. FASB utilities do not have to record depreciation on the asset because the install cost is zero. GASB, in our example, that's a $3 million install cost. That mismatch arises between those two. And so we use regulatory accounting under GASB 62 for the GASB utility to follow to get itself to the same treatment for contributions as the FASB utility. And you say, well, why would we do this? Again, it all circles back to rates. We don't want our customers to pay for something that we didn't pay for. It's not equitable. So the FASB utility, the install cost is zero. GASB, you would have your customers pay for an asset that they did not pay for. Or you could use some alternative accounting treatment, in our case GASB 62, to make sure that they don't pay for something that you didn't pay for. Here's a real life situation. We have a developer that installed electric infrastructure in a new subdivision, and eventually residential homes will be built there when the infrastructure of the subdivision is developed. The electric infrastructure consists of overhead and underground facilities, and it totaled $4 million to install. These are considered contributions in aid of construction. The $4 million of infrastructure, the developer paid for it, now they turn it over to the utility. Management doesn't like the treatment that GASB 33 says they should follow, and this is material to the financial statements. So then management presents a blanket resolution to its oversight board to approve regulatory accounting treatment for recording contributions in aid of construction. Of course, our board is awesome. They always say yes because we're always reasonable with what we ask for, and so they approve the resolution. Accounting-wise, what does this mean? And using regulatory accounting to get the job done. Well, in year one, the customer contributions in aid of construction of $4 million are deferred for recognition as revenue and future offset for depreciation. And so we set up a regulatory liability. We debit plant and service 101 for the infrastructure, that's the overhead and underground facilities, for $4 million. And we use FERC 254, deferred inflow of resources, contributions in aid of construction, regulatory revenues, for $4 million. 254 is the Federal Energy Regulatory Commission Uniform System of Accounts account for deferred items. This fits very well. And deferred inflow of resources is a GASB nomenclature for deferred items as well. They're both the same thing. So we have this liability set up for future recognition of the $4 million. What are we going to do with that? Well, here's the elegance of this approach. The contributions in aid of construction should be amortized over the life of the related assets by offsetting them against depreciation expense on those contributed assets. Here we have an example. Let's say the assets have a life of 25 years. So that means we take $4 million divided by 25 years equals $160,000 of amortization per year. Each year we'll make an entry to reduce our deferred inflow of resources for $160,000. We will credit depreciation expense for $160,000, and we will debit depreciation expense for $160,000 to recognize the depreciation on those $4 million of assets, and we'll credit accumulated depreciation for $160,000 to reflect the reduction in book value of those assets. And you look at that and you go, well, this entry's kind of dumb. We credit depreciation, we debit depreciation for the same amount, the net impact is zero. That's exactly the impact you're looking for. You didn't pay for those assets. GASB says you need to recognize that revenue. You say, we really don't think that fits our business model. We're more like a private sector utility, more like a cooperative. We don't want our customers to pay for those assets that we didn't pay for. But we still have to recognize the depreciation expense on those assets. So we will offset that depreciation expense with recognition of the deferred inflow of resources, those contribution in aid of construction, regulatory revenues. Instead of recognizing that $4 million all in one year, we are going to recognize that $4 million over the 25-year period of the related assets. The impact on rates. Remember, the intent of our transaction is that there should not be depreciation expense charged to ratepayers for something that we didn't pay for as a utility. The rate impact using this treatment is zero. We recognize the depreciation expense and we offset it with recognition of the revenues for those same assets since they were contributed to us. So we do an end around GASB 33 by using GASB 62, and then in the financial statements we show a current liability for the amount to be recognized as the depreciation expense offset in the next 12 months, and the remaining balance is presented as a deferred inflow of resources. As you can see on this slide here, current portion, the remaining balance is the deferred inflow of resources. Again, if your community isn't growing, if your utility isn't growing in territory, if you don't have a growing industrial base that you do more contributed work for, things like that, you don't have a lot of subdivisions going in, it's not material, I would not mess around with this. But if these are material items in your financial statements, there were some utilities that I worked for in booming communities where they had many hundreds of millions of dollars of these types of transactions going on every year. And the utility felt to recognize depreciation on these assets that they didn't pay for was a distortion of their financial statements, and they wouldn't be charging their customers for recovery of these assets either. GASB 62 came to the rescue and offset the requirements of GASB 33. Along with this, remember the financial statement disclosures of any material items and the notes to the financials showing what has been deferred, what is yet to be recognized, and all of those related disclosures. Our next topic is construction period interest. Now you might be wondering again,